Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most and do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Jason Yarusi. Jason is a private fund manager of over $245 million in multifamily real estate. Since 2017, his company, Yarusi Holdings, has amassed over 2,300 units of apartments. He is an avid ultra runner and is a workout enthusiast. He also hosts his own podcast, the Multifamily Live podcast, and runs a 7-figure multifamily mastermind. This guy wakes up at 4:32 a.m. And most importantly, is the father of 3 amazing kids and a husband. So, Jason, welcome to The Wealth Flow.
Hey, Keith, I'm excited to be here.
Yeah, I can't wait to dive into your story. But why don't we start with kind of where you grew up and what eventually led you to real estate?
Sure. Yeah, I grew up in New Jersey. I now live in Tennessee, in Murfreesboro, Tennessee, just south of Nashville. And I honestly left college and kind of went the non-traditional route. I just started working in bars and restaurants, right? Just trying to figure out my way. And I did that for a while, and then found a way to start opening up some restaurants. I opened up a bar. I opened up and sold a brewery. And then out of nowhere, my dad had been running this unique niche construction business where he lifts and moves homes. He was doing that in New Jersey as well. And he would actually take the structure and lift it higher most of the time for flooding reasons and a lot of other things, and maybe do that like 10 or 12 times a year. Well, lo and behold, Hurricane Sandy happens on the East Coast, decimates the East Coast, and his business goes from just, those 10 or 12 jobs a year to 1,000 calls each and every day overnight.
Oh my gosh.
So I had my brother who was working for me at the time, and now my wife Peely, who was working with me in New York City. We picked up, moved out of New York City and moved out to New Jersey to help Dad just take on this onslaught of work, just helping these people raise their homes and hopefully get back in their home and not flood again. Well, that business just exploded, where we went from that 12, jobs a year to almost 250 jobs a year doing this process for the course of 5 or 6 years. But what I found is throughout, I was constantly doing these transactional jobs, right? Everything I was doing was something I had to be very active in, right? So if you're working in a bar, you have to serve a drink to get a tip, right?
Yeah.
And we were running a very busy outdoor bar, right? And so the weather's not always perfect in Manhattan. So many times it would be closed. You just have no revenue. And then the same thing with construction business. It was so niche that you couldn't scale it in a way to bring on a ton of people. There was just too much risk involved. So we were actively doing so much of the process and couldn't put ourselves away. And so we were driven by the day and not having control of our time. And with my wife being pregnant with her, with our first kid, we just kept asking the question, like, how are we going to break the pattern to get back our time? And we came upon real estate, right? That word can mean a lot of things. Like you could flip homes, you could do Airbnbs, you could do what I do today, buy apartment buildings. And we did what we first came upon, right? You see a lot of these flipping shows. We started flipping houses and doing a lot of this wholesale work and having Airbnbs. And while we were doing good with that, it was in the same environment that we were before, is that we were so busy being transactional in these processes. Well, we came upon someone who was buying rentals out of state. And we met them at a real estate meeting in New Jersey. And they were just buying these rentals. They were putting together a management team, putting together contractors to do the renovations. And the management team would get it leased. And lo and behold, they'd move on to the next one. And that opened up our eyes to just something different from the pattern we were in. So we started buying 2 and 3 unit properties out in New Jersey. Out in the Midwest. And we did that proactively for the next 2 years. And that started going very well, right? We were doing that same thing. We were putting a lot of systems in place, putting a lot of teams in place to be able to have this happen. And what we found there is that we didn't have to go actively run the Home Depot. We didn't actively have to manage the contractors. We didn't actively have to lease the units. And lo and behold, we started having rent checks show up. We started having revenue show up. We started having these things happen without our time being involved.
Yeah.
However, it wasn't really scalable, right? If you would have like 10, 20, 50 duplexes around town, it just seemed like a logistical nightmare. So we sold off those little properties and kept asking what else is there. And I came upon, a podcast that someone was talking about buying apartment buildings.
Yeah.
And that was that aha moment where I said, I've had small restaurants and large restaurants, and it's the same process, right? But you can do so much more in terms of the economies of scale with a large restaurant. If you have a 12-seat restaurant, well, dinner is only, 5 to 7, right? So you'd only have that 5 to 7 window. But if you have a 100-seat restaurant, you think about all the exposure you can do to maximize your revenues. So doing a large apartment building made a lot of sense to me. So I dove all in, learned everything I could, and over the course of a year and a half, 2 years, started really get active in that community. And in May of 2017, we brought a 94 unit. That was our first acquisition of an apartment building. Since then, we've acquired just about 3,000 apartment units in the Midwest and Southeast.
Okay. Wow. There's a lot there for sure, but it sounds like a good transition from, kind of the smaller rentals to multifamily, and really just looking at being able to scale it into something significantly bigger. Tell me a little bit about that first 94 unit that you were able to purchase. Is this something that you did as part of a syndication, or is this something you did on your own, or what? Tell me a little bit about how that first one worked out for you.
Yeah, fantastic question. So we learned to buy these apartment buildings using syndication, right? It was the method that first was presented to us when we first learned about it. So we learned everything we did about that. So my wife and I ourselves, we handled all the roles from just finding where our market would be, right? So we started doing this in Louisville, Kentucky. We were very specific with what we wanted. We were looking for 75 to 150 units, BC assets built between 1970 and 2005. And we were very specific where we wanted them. We wanted them in the South or South Central submarkets there in Louisville, because that's where a lot of the workforce housing is. So we started putting together all the teams we needed, right? So empowering brokers forward with that message of what are we looking for, learning the process of other team members. So finding the right property manager that would fit that narrative, finding the insurance brokers that we would need from there, and ideally start to empower our friends and family to understand how this opportunity could be good for them if and when we found it. So instead, before finding the deal, we went out to our friends, went out to our family, and we said, listen, we are really excited about commercial real estate. This is the reasons why. You can get so many different advantages from an apartment building between cash flow, appreciation, both natural and forced appreciation, depreciation, tax benefits, the diversification, right? So we really think this could be a fantastic model to do as an investment. And with this, we're going to buy a larger building to get the economies of scale. And we want to show you the process of how these would work if you'd be interested in investing. In doing that, we allowed time for our friends and our family and our network to learn how it worked and to understand how this investment could be, because most, naturally just invest in stocks and bonds.
Yeah.
Doing that, we were able to get comfortable in understanding who would be ready to invest. And so we weren't taking money, but we were gauging how much we could potentially raise when that time would come. So we were comfortable we could raise a little over $1 million. And so when we went out to look at investments, right, if we found that the need for money would be about $700,000 to $1 million, we felt very good to be at that stage. So when we found this 94 unit, we were able to buy it at $2.3 million. I think the raise at that time was about $750,000. And we did that in a day because we had done the pre-work to empower our investors forward to know about the opportunities. Many times when there's like a new space, people will find the great opportunity that they see, but they won't empower forward first all of their investors. So it's like this thing that's so foreign to a lot of people, and they bring it to them, and the confused mind says no. And with that syndication, all the paperwork that can be involved, it can be laborious and it can be scary, right? If you don't do the prep work to allow people to identify why this could be a good fit for them and have time to just take it in so they can come back and ask good questions to make sure this fits within their investment profile. So we did that through a syndication, and we've done now, we've probably done about 75% have been through syndication today, that are 25% either have been just straight partnerships or just us.
Okay. No, that's great. And I think that's neat that you started out with kind of the education piece of it with your potential investors, your friends, your family. A lot of times that seems to be kind of a barrier, trying to get them, they may know that you've done these smaller rentals, but now all of a sudden to do something at such a large scale, there is an education process that needs to happen. Maybe could you tell me a little bit about how you were conveying, the opportunities and kind of educating them? What type of methods were you using for that?
So someone gave me great feedback. Just simplify it to the point here that you can allow them to take it, read through it, and come back and we can have a second conversation. So I basically just made a one-sheeter, just an intro one-sheeter, and just put down the avatar of the building, right? Here's the avatar of the building we're looking for, right? This is the building we're looking to find here. Here is how the investment would work. So if you invested $100,000, it would be treated that there would be a preferred return and a split of cash flow and equity here. And they would show that in writing. Then it would also show an example of how that cash flow breakout would be on a typical investment. Because we had a thesis here that we were looking for properties at that time that would be able to meet a 7 to 8 cash on cash return over the course of a year. I think it was 13 to 15 average annual return at that time, up to anywhere between a 1.7 to 2x multiple. And that was the deal that we were looking to find. That would be the opportunity we'd go forward with when we found it. So we spoke to basically, hey, we're not going to build it and hope they come. This is where we're going to find. And when we find it, that's how your investment will be treated with this type of property.
Yeah, that's great. I think that's a really smart way of doing it, just breaking it down to something simple, one page that they can look at. And obviously I'm sure there's some that followed up with that, with getting more details and more into the weeds on it. But that's great. What were some of the biggest differences on that first one that you purchased, or maybe surprises that were different from the rentals that you had before?
On a larger property, right, just imagine anything like there's 94 unit, there's 100 plus people that are living in this apartment building, right? So there's more people in that. So it's going to create more just interesting scenarios. We had a part where we had, in a week, we had 2 people pass away from natural causes, just from the elderly, right? Now, it just was Kentucky. Luckily, I had a management company that just understood how that process was made. Like if they can't reach the people, it actually goes through a set eviction process, right? So just things that you weren't to think ahead of, right? Because we weren't faced before. Yeah. Past that, we had an electrical wire that burst underground, took out the electric to a building, right? And so at least we had the team in place that we would get out there and circumvent that, right? And circumvent that and get that back on board within the course of the day so people could go on with the course of their life, right? So these things that would pop up that weren't, with more people, it creates more complexity, which creates more varying outcomes, right? And so with a single family home, you may have some outlier, but you see more things that will happen across the apartment buildings just because the nature of use is more heavy on them.
Yeah, makes sense. So obviously starting in Kentucky with that one, but where geographically have you invested since then? And maybe kind of a follow-up to that would just be from a property management. You mentioned property management. Are you using somebody that's specific to that market? Is there somebody that's managing your portfolio across the board, or is it market specific?
Great question. Market specific for sure. Okay. It's very important because the intimate knowledge a property manager has to the market is very important. And many times, unless you're just a very institutional player, you can have a large company that's overseeing across the board. I find just to get the level of need and attention, you have to have a person who's really dialed in and intimate to the market. So we're in right now 7 states. So basically it's Tennessee, Georgia, Arkansas. We sold out of Kentucky. We're in Ohio. We're in Maryland, North Carolina, South Carolina. And so in each of those markets, we either have a select manager that's in our market, or there's about 20% of the units that we manage now in-house. And what we did here is that the larger properties, you can find, just like I said, there's more value in the larger buildings. You can also find better partners from a management side on the larger buildings. Not to say that there can't be great partners for the smaller properties, but they need more mass, more volume. They don't have the runway or the infrastructure to be able to support the smaller properties in their best light. So we found that a lot of these mid-tier properties, so we manage a 44 unit, 29 unit, a 20 unit, 12 unit, a 36 unit. So like the smaller mid-tier properties, we were able to do a more devoted, better job managing out of the office than if we were to go out and hire on a third party. However, the larger properties, right? So 90 unit, 100 unit, right? In these markets, we find great groups. They do a great job for us to help us push forward the business plan.
Yeah, for sure. That's interesting. And then as far as, so you started with the 94 unit, then can you maybe walk us through kind of from there what you decided to purchase and, kind of what you've learned along the way? I'm sure there's been, obviously there's that learning curve with that first one, but, even from there, kind of honing in on what it is that you're looking for, what your buy box is.
Sure. Yeah, we really I think we brought about 400 units in Louisville. We've sold out of all of them now, but we did that for a fact and got really dialed into that market. Mm-hmm. And just the evolution of the market opened up opportunities for us to sell. So of the 30 so transactions we've done, we've now sold off full cycle 14 of them. So when we did that, we sold off and we moved out of that market. One, because I thought the valuations were running a little wild in Louisville and that I was having a hard time with the management side, the companies I had worked with during my course. I really had a great relationship with. I thought they were doing a great job. But they started to disperse to move into different areas. They were merging and then separating, breaking apart. And the companies that I had working with in the future, I just wasn't really excited about. So we moved out of that market because we find that the property manager, it's one of your most vital pieces, right? I can have the best plan in the world, but if I don't have someone to implement the plan each and every day, right, then what's going to happen is not getting the results I want. So we put a lot of focus down here in Middle Tennessee, right? So I don't invest I don't invest up in Clarksville, down in Chattanooga, out in Memphis or out in Knoxville. We're solely around Nashville MSA. We've been really dialed into that market, all the energy coming here, all the focus on here, the jobs, the job creation, the job diversity. So we've been very excited about what we've seen in this market. So we put a lot of focus just on building correctly here in this market, and that's really served us well.
Yeah. The Nashville area, just Tennessee in general right now just seems to be a very hot market. So yeah, that's neat to see. And then so tell me a little bit about your strategy. When you're buying these things, I assume these are value add, but kind of walk us through that. What are you typically looking for that you can, add value to, the levers that you're pulling to, increase that net operating income?
So ideally, you're driving two ways. Either you want to drive revenue or you want to control expenses. And where we get this intimate knowledge of the property managers, we can get more dialed in to get back economies of scale on the expense side, right? So we'll go in there, look at where the expenses lie, find where we can treat the resources. So we're acquiring 165 units here in town here. We'll have about 500 units here. What that allows, we'll be able to share resources between the team, the management, the on-site for the maintenance staff or the leasing staff, and that will allow us to cut down on that side of it, right? We'll also go forth and impart different things that can control utilities. So if there's not some water savings plan on the property, we'll look at utilizing some water savings plan, potentially changing out toilets, changing out shower heads and faucets and adding in aerators, right? Just to control what we can control there. Then we'll look at, on the income side, what is not matching the market, right? So is the rent levels in place? Are there things that we can do to potentially add on other income, right? So billing back utilities correctly or doing other things in fact, well, then we will look to impart that, right? So it's really just operational inefficiencies that will be treated where we can go and find maximum value to add on efficiency from both the income and the expense side.
Yeah, makes sense. Obviously,
there's one key piece I'll add in there. Sometimes marketing is a very key piece, right? Sometimes you'll take on the marketing is missed and very, just like any business, right? You could do a great job, but if nobody knows you're there, right, you won't have the impact that you want and it will hurt you on how you'll be able to go forth and lease at the rate you want. So we'll look at the marketing very hard, make sure, one, that the brand of the property is right. or if it needs to be recreated. And in fact, do they have the right footprint on where the marketing needs to be able to drive leads to the property?
Yeah, as speaking of marketing on there, what are some of the things maybe that you've seen that folks aren't doing that have been effective that you can implement from a marketing standpoint?
You want to know what works best with your market, right? And so you'll have times where apartments.com is your driver, and other times it might be Zillow, right? And other places it might be Facebook Marketplace, right? So you do need to know your market to know what's dialed in, because if you use a blanket recipe to just say I'll just use this platform, you might be missing on the results. Also, the way the sites work, you need to understand how they have to be optimized. Does it have to happen every week? Does it have to happen every month? Just to make sure you have the right listings in place. And then you have to do rent studies in the back end to just not put a price out there, making sure your price is matching the market, right? So if you're just putting out numbers and saying, this is my rental data, well, if you're not driving a lot of leads, it could be one, just the platform you're on, but you also could be outpricing what the market can hold at the time.
Yeah, makes sense. And what about from a unit standpoint? Are you going in and doing any kind of rehab on the units? And if so, what's kind of typical?
Yeah. So you want to see where you can match and drive value, right? Because there's a couple ways here you can look at this here, where you go forth, and if you could put in $10,000, but if you're only going to get $20 of rent back, then your return is not very good, right? But if you can go in there and put $5,000 in there and get $45 of rent or $100 of rent, well, then that might make sense for the business plan. So we look where if we did this renovation, the revenue that we could increase it by would get us our money back based on the money spent in 3 to 5 years. What that usually entails is that we'll go and put in LVP flooring. We'll change up the paint scheme within there. We'll change out at times the cabinets, or we'll reface the cabinets, or we'll change out the just the doors in the cabinets. We'll change out all the hardware, the lighting. We may either put in granite or just resurface the countertops and change out the appliance package. Typically, that will be a good runway that how we'll look at these properties. Mm-hmm. But again, we want to match the market. Right. There's that point where you want to match the market so you can maximize the value, but you also you want to be careful not to overdo it in the market where it's not going to add any value for what you're doing. Right. When we first brought that 94 unit, it had Formica countertops, and if I put granite in there, I was going to get the same rental rate. So I just keep the Formica, resurface them, and on that part, I was getting the same rental rate as if I put in granite.
Yeah.
And where it made sense for us to sell in the future is that we sold, I think 30 months after we purchased that one. And where it made an interesting play here is that over that course of 30 months, 2.5 years, there was a massive swing of just all the energy coming to that market. So people were coming in there and changing the narrative where they were starting to do these very high-end renovations. So it allowed a new buyer to come in there and add in new capital to do those massive renovations. So we were able to get a nice exit on that because there was the nice opportunity for the new buyer saying, oh, well, now there's all these new properties around that are doing this, right? So now we can replicate on that to get even more value from where it stood today.
Yeah, that's a good point. And obviously, for the new investors coming in, they're seeing that, hey, there is an opportunity. There's some meat on the bone here that they haven't executed on that can be part of our business plan. So that's great. How about maybe, obviously we're in kind of strange times right now. And I'd be curious to know how you guys have done this year from a purchasing standpoint, if you've taken on anything new. And then, maybe some of what you're seeing in the market, both on the delta between price and, it penciling out, or, kind of what you're seeing from a lender standpoint right now, if there's any pulling back.
The lenders, they're pulling back. That's been tough, and that's been happening for a while just because they don't know how to price debt going forward. The needle just keeps moving. Right now, it looks like there potentially is some clarity that we will not see rates be increased again, but right. to be told, right? So that's, who knows, right? But in that said, the deals on that front, we've purchased a couple this year. There's some things that, a couple years ago, loan assumptions didn't make sense, right? At all, right? Just didn't make a sense because people were trying to get out of a deal because of their increase of valuation, but they'd have like a 6.5, rate, right? 6.5% rate. And they'd have this huge prepayment penalty. So they'd say, you have to assume the loan. And you would go that if you were to assume this loan, well, you would have to bring a ton of equity to the table, right? Because their valuation had gone up so much. And then beyond that, you would have to go out there and either say, well, I could just go to the market and get a 4% loan, right? Or a 3.5% loan. So why would I do this, right? So it was hard for those people to sell. Well, now some of these opportunities make more sense. So we just assumed a building where our rate was a 3.3 from Freddie Mac loan, right? So we're able to get that on a building here in town. So we assume that loan still has 7 years left on it, right? So that's a great spot for us to get in a loan that if we reprice that loan today, the rate's probably going to be, 5.8 to 6.2, depending on where treasuries are sitting, right? So that gives us the opportunity to look at things a little bit differently. However, there are still banks. There's a lot of banks out there where the banks are still lending in a way, like things have pulled back. But I like going with banks where banks are more approachable, it's more relationship driven, and their terms might not be the best. But if you think that rates are going to level off and continue to decrease, they're a great opportunity for you to get into a project and not have this prohibitive prepayment penalty you can't adapt to the market in the future. So with a bank, maybe we'll get a 5-year term, maybe 1 year of interest only, 25 years amortization. But the prepayment penalty might be 1%, right? Or if it's a credit, it might be 0, right? So if the market changes in our favor, okay, cool. We can move without much impact to us having to pay a penalty to get out. And if the market stays the same, well, at least we have a constant for like a 5-year runway. So it puts us in a good light to make very good business decisions going forward.
Yeah, makes sense. And then what about from just if we're doing renovations, that kind of thing, what are you doing to kind of keep costs down, if anything, with materials? Are you, vertically integrating any of that as far as being able, finding suppliers that you can get stuff wholesale, or what does your business look like from that standpoint?
So that's a huge piece of having management companies. So our management company here locally has, 5,000 units, right, that they manage. And so with that, they get a lot of vendor pricing to their favor, right? So we're able to take into account for that. And also having a recipe that you go into that, we don't want to have the flipping mentality that every time we do something, it's going to be a different thing, right? My friends who are the flippers that do the best, they just do the same thing each and every time. And so where we can't control costs, we can control time, right? And so we can have a point here where each and every time the recipe is the same, where we can act much quicker, where the money can be saved on the time of getting it in, getting it done, and getting it leased, right? So there's two sides to it. So that's why we like working with large management companies that are really dialed into the market, because they get that built in on their side. And then also with a direct approach of how we want to treat these renovations, it allows us to act much quicker.
Yeah. And what about, have you seen any changes in the insurance rates over the course of the last couple years, or last year in particular?
Yeah, I mean, they have been going up considerably. You're seeing 10, 20, 30% increases for a lot of reasons, many because a lot of the companies that would out there to insure have pulled out of the market, right? So it makes less people there, or less companies in there to insure, and so less spread of risk, right? So you've seen a lot of people pull out of the market, a lot of people push away on older properties here. And so it's put a lot of downward pressure on rates, right? So where I started originally, I think if we were looking at it, it might have been like $300 a unit, and today, you're 550, 600, 650 a unit for the same type of property, right? So you've seen it almost double in the time since I've started.
Yeah. That's tough. It's tough to make the numbers work on some of that. I mean, obviously, if you account for it, then you're in good shape. But what about as far as kind of the future? What do you see? Yarusi Holdings. What's your 1-year plan, 5-year plan? I mean, what does it look like moving forward for you?
We consistently put the energy in to do a deal a quarter, and that's worked for us, right? And so we put the energy in, so the intention, right, and the actions. Now, it doesn't mean that we do a deal a quarter, but we put the intention and actions in to that work. And so typically that may look like, okay, we don't do a deal in the first quarter. Maybe we'll do one deal in the second quarter, maybe no deals in the third quarter, and maybe it's 3 deals in the fourth quarter, right? So we're patiently aggressive, as we'll call it, that we don't force a deal to happen, but we continue to do the work to allow deals to show up with the goal to hit 1 a quarter.
Okay. No, that makes sense. That's a nice, steady growth for sure. And I think trying to do too much, there can be some growing pains, in trying to do that. What about communications to your investors? What does that look like? What kind of a cadence do you have with the current investors?
Yeah, we do it every month on the 15th.
Okay.
And we do that at least proactively for usually the first 2 years. And then we might go to a quarter from there, but we do it proactively every 15th of the month. And we find that's a good runway just to keep everyone up to know on where they are with their investment. So we put that out when we close a property. We'll say this is expectations, right? Expectations are you'll receive this information on these dates. This will be on anticipated distribution days. This will be the open items. This will be when tax documents are expected. And from there, that will be our cadence going forward here until the runway, maybe the property life stabilized, and we may move to quarterly if there's not really a slew of information that can be shared each and every month.
Yeah. And so tell me a little bit more, going back to your company. It's you and your wife. Do you have other GPs that are part of the deals as well? Or is it primarily the two of you?
So we started to grow, and as you grow here, you can do it two ways, right? You can bring on partnerships, you start building out your team in-house. So we have projects that are both light. We have a couple partners that we work with a lot. They have their separate companies, and there are two other GPs that we work with a lot on our projects, especially here locally. We also have projects that we run here as our own projects, and then we have a team now that we've built here at Yarusi Holdings that help support the property and the operations and all the runway that gets us to the deals and get the deals closed and operated.
Okay. And tell me a little bit about deal flow and kind of, what you're doing to find new opportunities. I assume working with brokers, networking with them, but what's been working for you?
Yeah. So we'll say if there's 10 deals, 70% of them are going to come from broker relationships, right? So if you're thinking like, how do I get out there and like, what's that wild card? I'll go do mailings. Like you're still going to have about 70% of brokers drive the deals. So it's very important to just get out there and be specific with what you want to them and create that relationship. However, 30% is going to come from everything in between. Like we brought a $9 million deal off a postcard, right? We've walked across the street to the neighboring building and met the owner and brought a building, right? We've, met insurance people and even legal people that had people in their network that were looking to sell a building, right? So the other 30% is going to come from you being out there, telling what you're looking to do, right? And just being more open to allow people to come in and help you find that solution, right? We found it through property managers, right? Property managers is very easy because they are managing other properties where the sellers at some time will sell the building. And if they sell it, right, presumably it's probably going to be a new management company. But if you have a good relationship, you work with this management company and you can buy it from there, you'll empower that management company to still be employed by that property, right? So at times that can make sense as well. But 70% is still going to come from that broker relationship, being very focused and dialed in on what you're looking for.
Yeah, that's great. What about the mastermind? Tell me a little bit about that. I would assume that could be a potential, that could help with deal flow as well, as people are trying to look for people to partner and do very similar things. But maybe if you could just highlight, what the seven-figure mastermind is and, what your focus is and kind of where you guys geographically are.
So we, in New Jersey, when I was there, we started a meetup, and that was really powerful that, after we brought our first deal, we just had the idea that we should start a meetup just on multifamily. There was meetups on every kind of real estate, but not specifically multifamily. So we did that, and it grew to like 3,000 members. And that was a lot of fun, but it was a big thing that we just didn't have the capacity to scale further, especially as we moved to Tennessee. Right. So we moved down to Tennessee. We have some partners here, the same that we act as GP on with our partnership there. They came in fact, and went and we started 7-figure multifamily. The goal with that, make it easy to say, here are the steps that you can take action to learn the process to go out there and execute and act on apartment buildings. Now, as people come into the mastermind, they in no way we want them to go out there and do their deals. We in no way want them to do deals and have to bring us in. However, we can and will help on deals if it makes sense for where we are today.
Yeah, and then maybe some of the benefits of the mastermind itself. I love masterminds. I've just I've found that there's people that are all at different stages in their investment journey. And it doesn't have to necessarily be investment journey. It can just be in your life journey. But there's ways to be able to leverage everybody's experience. And so what are some of the things that maybe you've seen with that mastermind?
When we did the meetup, like we would meet once a month, and I would basically just go through the 12 steps that I use to just buy an apartment building. And like it would just take time, and people wouldn't have the ability to have it all to them together, right? So we all people shortcut it, right? Just saying like, listen, you couldn't go figure this out yourself. Like if they don't want the mastermind, that's not a problem. Like they can go out there and do this themselves. However, this is the ability to shortcut it, right? We're here that you can get the big steps. Like that's easy to understand. But if you need to have the in-between detail to go from A to B to C to D all the way to a deal, the mastermind empowers that forward. You're also surrounded by a lot of other like-minded people that you might not be around, and you're each and every day that are still trying to do the same thing as you, right? So it empowers forward a lot of groups to find synergies where they come in there and maybe they're good at a couple aspects. Maybe they're good at lead generation and they're good at asset management, but they're not good at the underwriting, or they don't have the balance sheet, right? Maybe they'll find other people that are there in a mastermind that could be good partnerships for them to take action and proactively go forward to meet the goals that they're trying to do by buying apartment buildings.
Yeah. No, that's great. And what are some of the things that you've seen, just maybe within that group, that kind of are the barriers, or where people get maybe hung up in the process? What are some of the biggest ones that seem to come up time after time?
To be honest, it's going to sound very simple. They will not stay focused to just be focused on what to find, right? So the shiny object syndrome is real in many ways. And so, to say that I was very specific when I started out, like Louisville, Kentucky, like 75 to 100, 125 units, BC assets, South and South Side submarkets built between 1970 and 2005. That's hard for people to focus in and hone in on because they just think they're going to miss a deal. But so they'll be like, oh, I was looking in Louisville, but then I got this deal and it's in Cincinnati, and then I got this deal, it's in Baltimore, right? And they'll start looking at all these different investments. And while, okay, could there be a potential opportunity there? Yes. But by the time you can figure out the market, figure out the team, figure out how to underwrite not only the project, but the neighborhood, just the area, right? Understanding how the metrics work within that, in fact, neighborhood and region, you've missed a deal, right? Because if you have 10 of these and you're looking at all these different markets, you have to set up all these different teams, set up all these different processes, set all these different runways just to find the deal. However, if you go and just hone in on a market, right? It's like the reticular activator, right? Like when you go to buy a car, you just don't say, hey, listen, I'm going to go buy a car today. You have an idea. Like I really want to get a blue Chevy Tahoe, right? So what happens is that you start seeing them everywhere in the street, right? Not because there's more of them, because your mind's kicked up to pick them up. And when you go, you're focused on what you're trying to find. Well, when you have the focus to get out of the gate, you find you get to the goal a lot quicker because you don't have all these things that are just running you off the road constantly. And you just got to put the blinders on. And when you do, people get to what they want much, much quicker.
Yeah, that's a good point, Jason. And what about maybe if we shift gears just a little bit and talk about from a lot of our audience, they're W-2 professionals. You mentioned it with some of the relatives when we were talking about kind of educating them, and they do the company 401k. Maybe they have a company match, but they don't necessarily know the benefits of being able to invest in this type of real asset. So maybe some of the benefits that if you can just talk a little bit about that in investing.
So what makes multifamily investing interesting is like, if you just have a house, right? The house is that you put money into the house, it's being flipped, right? So there's no money coming back in that time. And then hopefully at the end, you've made the right renovation to be able to spend the right amount of money, and you haven't get killed by holding costs, and hopefully you can sell it for a profit into the future, right? And then because this usually happens in a year, it gets highly taxed, right? With multifamily, what we have is the opportunity to come in there and buy a building where, say it's a 100-unit building, right? So the 100-unit building, maybe you have 95 of the units occupied. So those 95 units, hopefully will be able to sustain enough revenue that it's going to pay all your expenses, pay the mortgage, and after that, there's cash flow. Beyond that, we're doing select improvements when we buy that we're forcing forward the value, right? So if I go renovate a unit and say I renovate 50 of the units, and now instead of having $800 of rent every month, now they're $1,200 of value every month, right? Of rent we get. The property has more sustainable value into the future, right? So it shows better into the future. Past that, there's also the natural appreciation in the market, right? The natural appreciation in the market also lies here where, hopefully over time, if we're in the right markets, the markets will also appreciate. Beyond that, there's the tax advantages and depreciation where we use accelerated depreciation through a cost segregation study. So we're able to offset a lot of the losses up front to be able to give people a paper K1 loss to offset some of the other active income maybe they can write off at tax time. And then lastly, it's just the diversification of a larger property, where if it's like a 1-unit property, they just one revenue stream that's either there or not. And if just stocks, right? Stocks, you have to put $100 into the stock and hopefully it goes up, right? Where here we use equity, but we also have a loan on it. So maybe 70 or 65 or 75% of the building is brought with lower interest leverage than the equity amount that we're seeking. So we can usually push forward better returns than you would see in the equity markets.
Yeah, makes sense. And when it comes to multifamily, are there anything that you feel that typically folks don't realize about it that you can share with the audience?
Larger seems scarier, but when you think back to the same part, right? If you have one house and one tenant, if that tenant doesn't pay rent or just moves out or one roof goes or the HVAC goes, it all has to be handled by just that one tenant, which isn't going to be enough, or you, right? Mm-hmm. When you have a larger building, there's more economies of scale to have more things be able to be encountered by the project, and you can treat it where you can have a full team, right? So if I had a 10-seat restaurant, like I can't have a full team. So I might be running the register, right? I might be the server, right? But if I have a 100-seat restaurant, I have a management team, I have servers, I have the full back of the house, right? I have everything. Same thing happens in an apartment building, right? If it's a single unit, I can't have a leasing person, I can't have a maintenance person. So every time I need something, it's going to cost me more. With a larger building, I have a full team that's supporting that building, right? So I have a leasing staff, I have a maintenance staff that's hired by the property. So it happens to be more effective and function more properly than you would see on just a smaller asset. So although it is larger, it's why the banks treat it as a safer asset class, because the opportunity for us to sustain is much greater.
Yeah, for sure. And so maybe when you're not investing in real estate, you're not doing this. Your bio mentions ultra running. What are some of the things that you're doing outside of work?
Yeah, I work out. I like to work out a lot. I do that. And then I have 3 little ones, 9, 7, and 5. And so I'm really active in what they're doing out there. I coach a bunch of sports. And so really a lot of the time, especially school time, is built right now just trying to match with the kids' schedules, which can be an overall interesting play each and every week here.
Okay. And on the ultra running specifically, how long ago did you start doing that? And for just an average runner, I'm training for a marathon. It's going to be a trail run here in January, but
nice.
So I'm starting to do those long runs on the weekends and stuff. Obviously there's some techniques and different things that can help, but I can't even imagine with the ultra piece of the puzzle, just the mindset of knowing that you're going to be going out for a long time and running.
It's 50% your legs, 50% your mind, just like each and everything right there. And like, you have to proactively do it in small steps. Cause if you're like, when I started doing it, I think it was 2018. I think my first marathon was in 2008, am I correct? But I just never knew of ultra running, and I just heard of it one day. And so I went out there and signed up for a race, right? And, what I came upon is that like when you do a marathon, you'll have a certain pattern, a certain cadence. You'll start growing the number of miles. Maybe you'll do like 1 or 2 20-mile runs before you get to the marathon. And when I came upon like a 100-mile race, I was like, well, do I do 2 80-mile runs before? It just didn't make sense. So I was like, okay, what can I control beforehand? So I started running 6 miles each and every day, whether, it was cold, it was hot, my foot hurt, my ear hurt, I was sick, like my kids didn't feel great, right? No matter what, I ran that 6 miles. And what it did is it gave me the repetition, consistency, and the discipline to do that. And when I started on ultra running, I said, listen, I don't know how to run 100 miles. So if I just say right now I'm going to go run 100 miles, as I start this race, it's probably going to scare me from the cliff. What I can do is I can control 6 miles, right? So I said, let me just run to the first aid station. I'll figure out from there. And I kept that repetition throughout, that as I did this, it might get to the point where 50, 60 miles in, I said, let me just run 500 feet, right? And my mind's telling me to stop. Okay, I get it. I hear you, mind, but let me just get another 400 feet. Let me just get to the bridge. And if I want to stop, then we'll reassess then. Doing that in patterns of consistency and intentional execution, I was able to get to the end of the 100 miles over a course of 6 mile runs that I had trained for.
Yeah, that's great. Yeah, it's a great tip. What on those? Just curious, and I know you probably didn't know we were going to go into ultra as being part of the subject,
yeah,
but
I like it. Yeah,
but
great.
so if you are training for one of those, to answer that question, do you get up to an 80-mile run, or do you get up to this, for a long run, or is that primarily you're getting all the mileage on the big run itself?
Yeah, and all the miles. I mean, I would do 6. I would do 6 every day, and then the weekend I would do anywhere between like a 15, maybe a 35. Like I would just in between like of where those were. So I would do typically like a 6 every single day, and then on Sundays I would get up and just do a long run. And that long run could be 15 miles, it could be 25 miles, it could be 37 miles, or just like whatever was the course of the pattern, not broken out at all. Because I did a 50-mile run one time. It was up in Ithaca and in the mountains, right? And so that was my first one. And when I did it, I said, okay, I'm going to run the uphills because I'm really strong and I'm going to keep my feet dry. And that would be my way to be successful, right? So I get into this, and 3 miles in, it is so steep, you can't run it. Like so steep that you have to like almost like hike it and climb it. So I'm like, oh, okay, that's out. The 4th mile, because what I've never looked at the trail. So the 4th mile was the first of 4 rivers to cross. So I was like, oh, okay. So I got it. So new rule, no rules, right? So the new rule would just show up and just with a pattern of being prepared to just get to the ends, right? Without the part of having all these things I'm trying not to do. Because when I try not to do something, it's usually those things that say, oh, and then your mind takes a whole tear because now it's happened that you weren't prepared for it.
Yeah, no, that's great. That's neat. I'm sure that I know there are parallels with that with a lot of things, right? I mean, just the mindset when you can get it for something like an ultra run, it's something you can apply to business. It's something you can apply to multifamily as well. Just kind of helps with that mindset.
Discipline to keep going, right? Because each and every day we have to wake up with our own mind, our own outcome. And no matter what happened the day before, our mind's going to have a different opinion when you wake up that next day, right? So it's whether it's being about, getting up early, getting up and doing a workout, getting up and doing your run, training for your marathon, right? That's huge, right? But you could just say, I'm not going to train today, right?
Yeah.
I just won't train at all, right? And like that's a choice with a different outcome that will come in the future, right? But having a discipline to go do what you're doing to be ready for the race, right? That serves to have discipline.
For sure. Jason, maybe if you could tell everybody how they can find out more about you, how they can, possibly invest with you, that would be great.
Yeah, fantastic. So yarusiholdings.com, YARUSIholdings.com. That's our company, our holdings company for which we do all of our investments. So if you want to learn more about what we do in the day-to-day, just the type of properties we're investing in, type of things that we've worked on in the past or future offerings, feel free to go there. You can connect with us there. Also, I just recently launched a second podcast called the Live 100 Podcast. You can find that across out there as well.
Okay, fantastic. And if you have enough time, I've got 2 more questions for you. All right. One is a question. Both of these are questions I ask every guest. And that first one would be, if you're giving advice to somebody who's maybe just starting out in their investment journey, what advice would that be?
Don't judge the outcome. Most of the time we put together what we think is the right thing, right? But we find the first time we take the step that we actually don't like it or I dislike where we're going, right? And so we'll say, oh, I think I should do this, but then we put together this perfect plan and we spent months, years just getting ready, and then we take the step and we don't like it, right? But you usually don't know the answer because you don't know the right question to ask. And the right question to ask comes from taking the first step, because the first step might be like, I really don't want to do this. Well, great. You at least got that out of the way. It's been spending months and months learning about something. And then by the time you take action, then you discover it, right? So action creates the future of where you want to go. Inaction has always led to, of course, inaction, right?
Yeah. That's great advice. What about a book recommendation? Anything you've read recently that's been impactful? It doesn't necessarily have to be real estate related, but.
So I was reading Ryan Holiday's Daily Dad. That's always a fun read, right? So on that part, he does the Daily Stoics. So that would be one that came to mind. Renee, I'm reading a book now. Renee, I'm blanking on his mind, but it's just having more impact in the world is Renee is the first name over there. So I have to think about it. I can hit you back on that one. But I think the Daily Dad, good recipes, especially as I have a growing family, just to keep me grounded and just keep me on the plane to think about how I'm parenting and not just parenting.
Yeah, I love a lot of the. I haven't read that one, so I'll have to give it a go. But Ryan Holiday's got some great stuff. All right. Well, Jason, hey, I appreciate you being on the Wealth Flow. I know you've added a ton of value to our listeners, and I have enjoyed our conversation here today.
Yeah, thanks, Keith. This has been awesome. Great questions.
Thanks.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.